Well, hello everyone. It is Friday, 8/2/24. I am Delbridge, Benchmark Realty, Murfreesboro, Tennessee. If I can get that into frame, we've got a good status chat for you today. And I tell you what, the financial news today is about like trying to take a little sip from a fire hose. It's hard to do. So let's get to it. If you like this content, please go to CallDelToSell.com, find the tab that says on YouTube, click it, and it'll open up a page of QR codes. There you can use a smartphone to scan and get to the YouTube page, or you can just mouse over and click it on a PC. There you'll be able to subscribe to this little button over here and click the notification bell so that YouTube will notify you when each Friday's blog has been uploaded. Thank you. All right, now I opened the pre-show today, the one we put out just to let people know to watch, to remind people that we have a status chat every Friday video blog, and we had this source here, which is, of course, Mortgage News Daily. And they're an industry-related group of people, and they do surveys every day. Now, I'm waiting for the 4 o'clock, which will be in 2 minutes, but we've got a storm rolling through, so I better get back to this. So I use this in the tease for today. Do you see that little blue line that goes down there? That is the daily rate right down here, the Mortgage News Daily Rate. Let's go ahead and zoom on in on that a little bit so you can see that a little bit better. The blue line is the daily rate, Mortgage Bankers Association. Freddie Mac is this one, and we see the Mortgage News Daily. Look at that little hockey stick there. All right, well, let's see what else we've got. See if we can squeeze this in quickly. All right, I just done a Google asking for stock market news, okay? So let me ease back out a little bit. Pull this up. Top stories. CNBC, Dow loses more than 750 points. NASDAQ enters correction after a weak jobs report. Says 23 minutes ago. Well, I know at one point it was down 1,000 points. I saw that, and it bounced back up. I think largely due to program buys. Whenever you see a stock market or something crash real quick, or commodities market, a lot of that stuff is set up on triggers, whether it's direct or indirect. Like individuals say, well, if it drops down this far, I've been watching stocks been going up, so if it drops down, say 2%, go ahead and buy it then, and that kind of stuff. So some of it's program buys, but then that rebounded, crop back off. So apparently, according to this right here, we are down 750 points. Dow Jones and NASDAQ sink as jobs report adds investors worry. Amazon is probably gotten some slower sales. We can look at tech-heavy NASDAQ sinks into correction zone, has equity sell-off. Versus why Intel stock is crashing. Well, that's an interesting one. Intel in particular is a tech stock, but I don't know if you notice, most gamers like AMD, it's a competitor. They've always been second banana to Intel. They kind of came on way back in my younger days. But anyway, the gamers like AMD. Now, AMD has a new chip coming out. It's about that time of the year, the last kind of half, certainly the last quarter, they get into their new products for the next year. Well, Intel suddenly came up with a whole bunch of reports that their biggest and best, their flagship, their i9 is burning up. And it's got a lot of watt density, but if it's unlocked, then the people can then overclock it, put a lot more wattage. Some people are putting twice the wattage, maybe 100 watts more than what it's actually rated for, and it can damage the chip over time. So that looks bad. They started having some bad press and some press releases on oxidation, some other stuff, and the gamers are just going nuts on it. Consequently, the new AMD chip, their competitor, had a stall on their release. So what's going on with that. So some of that you may not be related to the economy. Some of it may just be business as usual. All right, so let's get back to that. So we have capital is flowing into big money center bank bonds during stock market plunge. Stock market today, stocks crushed as markets see Fed rate error. Oh, we could look at that one. That might be a good one, but we don't have time because we got the storm front coming. And let's look at this one right here. So this is the volatility index, all right, for the stock market. And you can Google that. That's all I did, actually. But now this is the one-day volatility. It started at 21 at 8:30 a.m. And as of 1:40, which I've been parked waiting for the close of business for Mortgage News Daily, so I get the daily rates, and it's up since then. But let's back that up, let's see, to 5 days. Well, you see what's going on? We came right on into here, and what happened right about the end of September, right? We had the meeting with Mr. Jay Powell, and he started talking a little dovish, like, yeah, we're still not necessarily going to cut the rates, but we might. He's starting to sound like it, and everybody's kind of having a big, great time with that. And then suddenly we hit this today. This is obviously today, August 1. You know, we had the meeting on 31st. You know, it's like, oh, well, there we go. It's not too volatile. We should like it, until something happened. We started noticing the overnights, and boom, today's jobs report sent the volatility through the roof. All right, let's look at, we always talk about it. We're going to look at the 10-2 here in just a little bit, but this is CNBC. It looks pretty good. I've got it kind of blown up for your benefit. Let's bring that in there a little bit for you so you can see it, CNBC. This one happens to be the 10-year Treasury, right? We always hear so much about the 10-year Treasury. Well, let's look at what has been happening over the week. Here we go. We're trucking through here, not really doing a whole lot till what happens. Jay Powell talks on the 31st. And then, you know, the people are trying to make sense of that. Suddenly we drop down. We get a hockey stick down south. And then we got the jobs report, another hockey stick down south. Because remember, we did also have a different type of jobs report come in after Jay Powell spoke. So let's look at, let's see, what tab am I on? Let's look at this one. This is, since that's the 10, this is probably going to be the 2. Yes, the 2-year Treasury. And look at that right there. This is one day trucking along until the jobs report. Look at that reaction. Look at that reaction to that. So we're definitely getting some level of volatility. I think we've got a little bit more than that coming at us, and we'll look at that. We've covered this before, but we'll get to it. Again, I'm trying to beat the storm, not trying to rush you or cut it short, but I'm just trying to get this done. Let's look at this next one, which is the 3-month, the short end. Right, there we had 3-month Treasury, and because it's a little bit more blocky, we do see sort of the same behavior here. We went from 5 1/3 basically down here to now, if I can catch that last little line, 5. So we've lost 1/3%, or about 33 basis points. I could probably hit a rehash, see what has happened. Let me re-up this since I loaded these screens, see if it'll come up, if I still have internet. There we go. How about that hockey stick? Boom. So what does that tell you is going on? Well, it tells you that, for one thing, as I've been telling you, I'm neither a Pollyanna person that just sticks my head in the sand and says everything's beautiful and, you know, Norman Vincent Peale, everything is going to be all right. A power of positive thinking. I like to look at things realistically. I'm also not a negative Nate or a Downer Dill, I guess we say. So I like to be somewhere in the middle. I like to see where my options are. So flipping back to that one last time, we see the shorts, 3 months, have suddenly dropped on the yield. So we see the stock market dropping. We see the bond markets dropping. Let's look at the one thing we call the 10-2, where we talk about the spread between them. And this is from Fred, Federal Reserve. It's economic data. It's what Federal Reserve economic data. Fred, St. Louis. St. Louis is out of Fred. We got some other stuff. GDP Watch is out of Atlanta. Different banks are sort of in charge of everything. You know, and here we were. This is not super big, but this is the difference. The 10-year minus the 2-year. And we always should have the longer term. The longer term bond should pay more because it's tying up money for a longer period of time. Right? So we should always have the long end paying more than the short end. And it's not really a good sign when it inverts and the short end is paying more than the long end. But it does happen. So here we have it. Back in about 2018, we were still positive like we should have. And even though that we're still higher on the long end than the short, we still did have that little bit of that recession. Of course, we know about that is tied into the virus, that man-made virus that somehow snuck out right about the election time. And then it went up. We doing a little bit better. And all of a sudden, we started spending the money and all of the quantitative easing that's floated all of that money out there, and eventually we ended up getting inverted. And that may not seem like a big deal, but let's put this in context. If I can grab this little thing at the bottom, let's bring that. You see me moving right there, and I'll take my face away when we get ready to talk about it. We're going to take it back to the dawn of Fred time. Now I'm going to make my little head go away. Here we go. What do we see? What happens? Why we've been kind of concerned? Well, we've talked about this in past episodes, probably for 6 months. Once the curve inverts, that's usually a sign something bad is going to happen. Now here we actually inverted, we improved, we inverted again more deeply and inverted. And then of course we got caught down with a recession actually while it was deeply inverted, rebounded, same basic process. It inverts. The short is actually more profitable than the long, and it rebounded and got caught with a recession, a rather long one here around 81. That was post Carter and Ford years. Reagan had to take over, had to straighten some of that stuff out, get the spending. We had a little dip here. All right, doesn't mean that we're going to have something bad in the immediate future, but look here. This is March, right? March of 89. It wasn't until right about July, almost a year later, a little more than a year later, that we actually hit the recession. So there's a year delay. But what we see, the behavior that we observe is when the curve inverts, a recession follows. When the curve inverts, a recession follows. And it can go up and down. That's not too bad. It looks like it barely touched it here, not a big deal. But it came down for some length of time, and eventually it crossed back over. Recession happened, right? Because the Fed is doing its little job, and the Treasury is doing their little job with setting bonds, volumes of bonds and rates, and recession. Now we've had through this long expansion period. Where have we been? We have gone inverted for quite a while, and if we can sling this back up a little bit, bring us back up, we can see that we've begun to travel up. Now, it may be a year or more, depending on a million other factors in the economy, of if and when we hit a recession, a legitimate recession that the news media can't deny because of their bias. But it does look like we're headed that direction. Everybody, that even if they're being positive, has had this in the back of their mind that at some point the shoe's going to drop. And for some reason, on today's unemployment numbers, they started to have that little bit of a fit. So let's take a look at that. And one little tidbit, I think I mentioned this in the tease for today's status chat, was the SOM rule, because you might have heard about that. I know I posted on that earlier this week, telling people, look it up. So here we go. In our main panel, we have the SOM rule. Just Googled it. I Googled it. You can Google it. What it's going to tell us is the SOM rule, it's actually an observation, says a recession is underway when the 3-month average of the unemployment rate jumps more than 0.5 percentage point in a year. Now, it's a fortune explanation. We're going to look at the Federal Reserve Bank. And here we do have our SOM rule recession indicator. And you see when it starts to come up, we have recession. Starts to come up, recession. Start to come up, recession. You get the picture. We had a little one right here, but that was the COVID, the unconstitutional COVID shutdown. This, of course, is from the Federal Reserve Bank in St. Louis. And I think we can read the notes if I can zoom in on them easy enough for you to see. The frequency is a monthly calculation index is updated. The SOM recession indicator signals the start of a recession when the 3-month moving average of the national unemployment rate, the U3, that's a particular chart obviously, rises more than 0.5% or more relative to the minimum of the 3-month averages from the previous 12 months. So we find the 12-month low before, and we see where the 3-month moving average, when that 3 months worth is above the minimum in the last 12 months. That's the start of a recession, I think is what it's saying. Now, this indicator is based upon real-time data that the unemployment rate and the recent history of unemployment rates that were available in a given month. The BLS, Bureau of Labor Statistics, revises the unemployment rates each year at the beginning of January when the December unemployment rate for the prior year is published. Revisions to the seasonal factors can affect estimates in the recent years. Otherwise, the unemployment rate does not revise. The rule is named after is Ms. Claudia Saw, and I think I saw just an interview with her just a month or so ago. It was from 5 months ago, so it's a 6-month-old video where they were asking about the Psalm rule. It's an observation she made, and I think that she was chairman of the Fed at that time, but we can look that up later on. But anyway, we got to wrap this puppy up and get it in there before the rain comes. Let's go ahead and look at the CES. I checked the runtime. I'm at 13 minutes, almost 14 minutes right now, so we'll have to hit this quickly. This is the U.S. Bureau of Labor Statistics, current employment statistics. I always like to call it the current employment situation, but that's not what it's called. Same basic form we've had here each time we've talked about it. Total non-farm, they show all this up here as having the growth, and then everybody else down here, wholesale, trade, all these, not much activity, but we're going to look at this right here. Employment summary, August 2, 24, that's today, 8:30 a.m. I think this is what set a little bit of those hockey sticks in motion. Household data, establishment data. There are two different groups here. And for a long time, we've been hearing the household data tell us some things, quite honestly, that we have felt. But the establishment data has been saying it's very rosy. Household data has been telling us something else. So we're going to look at that right now. See if I can't spend any more than a little bit of time on this because we do want to get this done. The unemployment rate rose to 4.3% in July, and non-farm payroll employment edged up by 114,000. Sounds pretty good to me, 114,000, except that it was less than they wanted. Employment continued to trend up in healthcare, where we've been talking healthcare and government. Now they're throwing in construction, transportation, warehousing, while information lost jobs. We saw that on Thursday. The news release presents statistics from 2 monthly surveys. The household survey, this is the one that most closely represents us, unless we're tigers and moguls. Labor force status, including unemployment, demographic characteristics, and the establishment survey measures non-farm employment hours and earnings by industry. For more information about these concepts, you got to read the note. But now you see this thing right here, Hurricane Beryl. They're blaming part of the bad turnout on a hurricane. Well, it could be the hurricane, they say. Household survey data. The unemployment rate rose 0.2% to 4.3%. In July, the number of unemployed people increased to 352,000 to 7.2 million. Can you imagine that? We've gone up on less than 500,000, but more than 1/3 people in 1 month in the unemployment. Now, we look at this. I don't really have time to go through a lot of this, but I will put the full report in your links over on the status chat page where this thing is so that you can read this and you don't have to fish it out. Now, let's see. One of the things that we're talking about, though, is the surprise that it's gone down lower than we expected it to be. And that's what people are kind of freaking out a little bit about today in the markets, about it came up a little bit lower. There's something else that we need to talk about. A discussion was had today on the Facebook where people were saying, well, you know, the data is the same as the data has always been. There's nothing changes in the data. And we had to have an au contraire, mon frère time, because what does this say? The 2024 preliminary benchmark revision to the establishment survey data to be released on August 21st, 2024. We can read all of this about the when, but here it's talking about preliminary benchmark revisions for all major industry sectors, as well as non-farm and total private will be available. So they're changing how we measure, which is an old trick that we're not unwise to. The final benchmark revision will be issued with the publication of the 2025 January employment situation release in February of 2025. The reason I point this out to you is because if you remember, if you've been following me that long, in January 1, 2023, when we were having all of that terrible inflation coming out, we were hitting 9%, they revised how the CPI was calculated. They changed how that was done. And since then, we've been trending down on our inflation numbers. Could you believe that? If you don't like the way your test is graded, you just change the scale of the grading to suit your needs. So I think we've got a little bit of fiddling going in with the data, and I think we have an overreaction and a panic today in the stock market, the bond market. I think people are just set on edge. Remember Rudyard Kipling poem, if you can keep your head about you when other people are losing theirs, then you can be a man, young man. So here we are. Let's wrap this thing up and get to our daily numbers. Hello, I'm Delbridge of Benchmark Realty, Murfreesboro, Tennessee. If you are currently unrepresented and would like to know how to compare up to 3 properties side by side and room by room, then go over to my new YouTube channel, CallDelToSell. That's 1 L and Del, no spaces. Watch the demo on Real Scout and then call me and we'll set up your exclusive ad-free account today. All right, we got to be quick now. 7/26 of 24 last week. We had 22,797 in the opportunities. That went up over the previous period. We had 4,277 in the under contract, still showing that decreased a little bit over the previous week. And the ratio between those two fell by 1% to 19%. This week, Friday, 8/2 of 24, we had 22,493 in the opportunities. That's a decrease over the previous week, and 40 were the under contracts, still showing that also decreased, and we lost another percent in the ratio between the under contract still showing and the opportunities. So we appreciate you. We need to get this thing cut and uploaded, and as always, I appreciate your comments when you have them, your likes, your subscribe, hit the notification bell, because I always try to give you a little bit different look. No, let's not be a negative Nelly. Let's also not be a Pollyanna Pete, because it's somewhere in between. That's where we want to be, somewhere between the ditches. We need to keep our minds so that nothing's a surprise and nothing's a disappointment. Appreciate you. See y'all in an hour.